Good morning everybody, it's Jerry Hart here and welcome to the latest Practical Tax Update webinar from 2020 Innovation. We're going to look at a number of topics today, many of them from the somewhat curiously named Finance Number 4 Bill 2012, although one understands that will become the Finance Act 2012, and that bill understandably puts plenty of meat on the bone following the budget announcements which we concentrated on last time. But there are also a number of other important tax developments which we need to consider. The first topic is company car changes and strategy right through to 2016-17, because the government, or successive governments, have always recognised that if they're going to change the company car regime, normally to the detriment of the car user, of course, then there needs to be a big lead time, because people can't normally change their company cars overnight. And they now announce what will definitely happen for the current year and next tax year, and indeed the one after 2014-15, and what they intend to do for 2015-16 and 2016-17. Here's an interesting point, next topic on page 10. I don't know if you've seen this. HMRC have just launched a ready reckoner for the newly self-employed. Now, some of you may, I can imagine you saying this, and we perhaps could do an online poll if you're willing to put that down in the question or even the chat section. But some of you may well be feeling increasingly uncomfortable. I don't know, it's not for me to say that, but you might be, with what is an increasing amount of information, tax information, that the revenue are supplying to what they call their customers, who are also, of course, our clients or potential clients. I'm thinking that you may feel, well, hang on a minute, this is our role to help. And it's not really up to the revenue to give too much information away. You may have that view. On the other hand, you might think, no, the more information the revenue gets out to the client, that relieves me from doing some of the minutiae of my work. I don't know. You will have varying views. But for those of you who do get a bit upset, or even very upset, about the increasing amount of information the revenue are giving on the tax system, I would have thought that although your view is understandable, perhaps the best approach is to embrace what the revenue are increasingly doing and make clients and potential clients confident that you will use on their behalf all of the information that the revenue provide. Put it another way, what you could say to yourself and to your clients is that we will follow what HMRC says, because that will keep you out of any tax trouble. But at the same time, we will take proactive steps to get you the best tax result. Okay, let's move on arguably a bit more seriously, and look at a new system that we knew was coming in. We've now got the full details in Clause 49 in Schedule 14, the pretty extensive system of giving income tax relief or corporation tax relief if it's a company on gifts to the nation of preeminent items. Now, this is a new scheme coming in. It's quite generous. I can imagine some of you thinking, well, I can't really feel that any of my clients will want to take advantage of this, or even if they wanted to, will be in a position to, because I can't imagine they've got any preeminent objects. I mean, that may well be the case, but we won't know, will we? Just because the client has a particular level of income, which is maybe all we know about them, we might know a bit about their assets as well, doesn't mean to say they won't qualify for this relief. On the other hand, it would be silly to give clients a massive amount of information, which implies that this is a wonderful, extensive new tax relief that everybody should be taking advantage of. Let's move on to page 19 and have a look at what they've done. We knew this was happening on capital allowances on fixtures. As anticipated, changes to the capital allowances rules on fixtures, all with the aim that overall nobody in total gets capital allowances on more than the original cost of the fixtures. This has been a bone of contention by the Treasury for years, where many of you have been involved, no doubt, with your clients who bought a second-hand commercial property, a nursing home or hotel or whatever it might be, and you said, well, part of that purchase price relates to fixtures, which are integral to the building, things like lifts, air conditioning, etc., which in reality become part of the building. And you've been able to, quite justifiably, allocate a fair old chunk of the purchase price to those items, and therefore justifiably generate a substantial capital allowances claim.